Hi traders, and welcome to the 5th video of the Impact Strategy. In this video we're going to be speaking about the technical analysis tools and indicators that we can use in this strategy. We'll talk about their settings and the rules behind them. Most technical indicators are lagging, which means they are slow and a little bit behind price. They tell you what just happened. However, by combining historic price action with predictive tools, we'll have enough evidence to form the basis of a trade plan. So once we're on the chart, we will be going over the 200 EMA, used for trend and fair market value, the 21 and the 50 EMA, used for measuring momentum and dynamic support and resistance. Then we'll show you how to use pivot points, and that we use them to define our buy and sell zones, targets and stop losses. Then we'll talk about the RSI and that we use it to spot divergence and measure market conditions. Then we'll talk about the stochastics, that we can use it as an extra confirmation to pull the trigger, and it also can be used to spot divergence. Then we'll talk about the parabolic SAR, which we can use to actively but manually trail our stop loss. And we can also use Fibonacci as a tool to measure retracements and determine price targets. We'll go over these tools one by one, so you'll have a better understanding about them and how to use them, especially in this strategy. Let's head to the charts. An indicator that we use in the impact strategy to add extra conviction to our trade, and a very strong one, is a moving average. Or I should say moving averages, because we use multiple. There is no impact strategy without a moving average. We already touched down on moving averages in the course, but this time we will go a little more into detail and how we use them in the strategy, how many we use and what their settings are. So as I said, we use multiple moving averages, but all with their own functionality. Let's start with the biggest one, which is the 200 exponential moving average. The reason why we use this EMA is to define trend. Let's open indicators, type in moving average, and as you can see, for me it's already selected as a favorite. Moving average exponential. Make sure to select the exponential one. Click on it and it will be added to your chart. Close the window and double click on the moving average to open its settings. Leave everything as it is except length. Change length to 200. Then go to style, and I always give my moving averages the same color, so I always immediately know which one it is. The 200 EMA is always green for me. So let's choose green and click OK. Now the green line is a 200 exponential moving average. So what is important for the 200 EMA? If price is above the 200 EMA, we can say that we are in an uptrend, and so we are looking for buys. If price is below the 200 EMA, we can say that we're in a downtrend, and so we're looking for sell opportunities. Sticking to this rule will reduce your losses. Now, especially when the 50 EMA is above the 200 EMA, we have even more conviction that it's an uptrend. The same counts for a downtrend. If the 50 EMA is below the 200 EMA, then we have more conviction that it's a downtrend. Let's add the 50 EMA to our chart. Add indicator, select moving average exponential, close the window, double click on the moving average, go to inputs, change length to 50, and I always change the style to blue for my 50 EMA. I also make the line a little bit thicker and click OK. Let's add our third and last EMA to the chart. Add indicator, select moving average exponential, close the window, change settings to length 21, and the style for the 21 EMA is orange. The 21 EMA and the 50 EMA is what we call the market. They also indicate the speed of the market. The further they are away from each other, the more aggressive that the market is falling or rising. If these two are going up, then we can say that the market is bullish. So ideally, to enter a buy position, we would want to see price above all moving averages and have the 21 above the 50 and the 50 above the 200. And of course, it's the other way around for a bearish situation. The ideal situation for a sell is the 21 below the 50 and the 50 below the 200, and price being under it. Now, we're not always going to get the perfect setup or the perfect situation presented to us on a silver plate, but that's the ideal textbook situation. technically the market has turned bullish or bearish when the 21 EMA crossed the 50 EMA. So as you can see here, the orange 21 EMA crossed the 50 EMA to the upside, so from this point the market turned bullish. And technically the market turned bearish from this point, where the 21 crossed the 50 EMA to the downside. One thing all EMAs have in common is that they all act as dynamic support and resistance. A lot of times we will see when price breaks the 21, it will find support at the 50 EMA. If it does break the 50 EMA, then a lot of times we see it find support or resistance at the 200. The 50 exponential moving average is our favorite one and also most used for entries. This is the one we use most for dynamic support or resistance for extra confluence. So if you only want to use one moving average, I suggest using the 50 EMA. The 50 EMA is a crucial building block for the strategy. That's why I made it a little thicker than the other two. Can you see how price pulls back into the moving average and respects it before making another impulsive move? I probably don't have to tell you how strong this is in confluence with our other conformations. The 21 EMA is mostly used for signaling the crossover. Now, when the market is really aggressive, then we might use a 20 EMA on the 4-hour time frame for a more aggressive entry. But mostly we use it to see if we have permission to buy or sell. Okay, so now that we've gone through all the different kind of moving averages and how we use them, we can move to our next indicator. Let's delete these moving averages for a while so we have a clean chart to explain the next indicator. Don't worry, when we've touched on all the components separately, we'll combine them and then you'll understand how they work so well together. Or maybe you already do, who knows. The next indicator is a very important part of the impact strategy. It's probably the most important one next to market structure. We'll be explaining pivot points. You already had a pretty good explanation about pivot points in the course, but nothing will be more clear than showing you on the chart and really seeing it into practice. So when you go to indicators and you search pivot points on TradingView, you don't just type in pivot points. The one we use is a custom-made indicator created by a guy named Joe, and he created the indicator for my mentor Wayne. So you type in Wayne's pivot points. Just type in Wayne and it will come up. For me again, it's selected as my favorite. Click on it and it will be added to your chart. When you select the indicator, it looks very different from mine. Don't worry about that. It's very easy to change the colors in the settings section, but be aware sometimes Joe updates the TradingView indicator, so don't panic if by the time you watch this video the settings look a little bit different. Normally there are no major changes. Okay, so how do they work? A very important thing to know and a good thing to start with is that we have 1 hour and 4 hour pivots, daily pivots, weekly pivots, monthly pivots, even quarterly pivots and yearly pivots. Now we will almost never use the quarterly or the yearly pivots, but the other ones definitely need our attention. First of all, let's get a common misunderstanding out of the way. The pivot name, for example, daily pivot, as you can see here, stands for the duration of that period of the pivot, not for the time frame. So this daily pivot session block, for example, is one complete day. Here's the thing. A 1 hour pivot is on a 1 minute time frame. A 4 hour pivot is on a 5 minute time frame. A daily pivot is on a 15 minute up to a 1 hour time frame. A weekly pivot is a 4 hour time frame and a monthly pivot is on a daily time frame. The ones we most use in the impact strategy are the weekly pivots on the 4 hour time frame to swing trade, the daily pivot on the 15 minute, 30 minute and 1 hour time frame to intraday or day trade, and the 4 hour pivot on the 5 minute time frame for scalping. They all work the same way and we can even look for overlapping pivots. It's not necessary to find a good trade, but if we do, it adds extra conviction to our trade. Let's say you are on the 4 hour time frame and you've applied the weekly pivots to your chart. So you're on the 4 hour time frame and you're looking for a swing trade. A trade that might go for a couple of days, up to a week or even a little bit longer. What you can do is mark up the weekly central pivot point, then scale down to the 1 hour time frame, which will show you the daily pivot points. If the daily pivot point is overlapping your marked up weekly pivot point, you have an extra confirmation, and actually that's a very strong level where price has a greater chance of rejecting from, and there's an increase in probability. That's how we day trade into swing trades. So actually we have the small stop loss advantage of a day trade, but the target of the weekly pivot points. You can also stack your trades this way, because you already predefined your swing target. You can move your stop loss from the first trade to break even and put another one on when price is in your buy or sell zone of the daily pivot of the day. You can do this tomorrow and the day after as well. As long as your swing target hasn't been reached, you can use this technique to build a portfolio of trades. You can even do this on bigger time frames. Go for the monthly pivots and then use the weekly or daily pivots to stack trades for the complete month. Just put them break even, put another trade on, put that one break even, put another trade on, put that one break even, put another trade on, and so on. And by the time price reaches your monthly target, you have a lot of trades running and be in profit quite a lot. Of course, this will take a lot of experience, practice, and patience. So trading with the daily pivots is called day trading, trading with the weekly pivots is called swing trading, and trading on the monthly pivots is called position trading. They are revealed on the daily time frame. So, in the course video we saw what the best places were to buy or sell. M2 for a buy and M3 for a sell. No matter what pivot you're on. If you're on the daily pivot, the monthly pivot, the weekly pivot, it doesn't matter. At M3 sellers are looking to sell, and at M2 buyers are looking to buy. Now traders also enter at the pivot itself. That's a more aggressive entry, but sometimes price just doesn't go into the buy zone or sell zone, but just bounces from the pivot. Something that we like to see is that price is at M2 or M3 when the session opens. So when we have price at an M2 on a Sunday market open, there's a very good chance that it's gonna be the low of the week and we can buy the pair for the rest of the week. Of course, the market needs to be bullish if we want to buy. We don't care about price being at an M2 in a downtrend or price being at an M3 in an uptrend. If price would break structure to the upside and then retrace to the M2, that's a completely different story. Or break down and retrace to an M3 after creating a lower low, that's fine as well. Now, where to put our stop loss? There are two places where we can set our stop loss. Well, actually four. 2 for buyers and 2 for sellers. Using pivot points, we always have a conservative and an aggressive level. It's like that for entering, it's like that for our stop losses, and it's like that for our take profits. How do we choose which one we take? That depends on your risk appetite, and maybe a little bit for market structure as well. This is how it works. If you choose the aggressive stop loss, which is a shorter stop loss, your trades will be taken out more than using a conservative stop loss. That's just the way it is. But your trades with an aggressive stop loss will have a higher risk reward. It's for you to decide, but it's best to always try and stick with the same method. Personally, I usually go for the aggressive stop loss, which is just a little bit below the green buy zone, so just below M2 if I'm buying. The conservative stop loss is just below the next pivot level, which is the S1 level. When I'm selling, I tend to put my stop loss just above the red sell zone, which is just above M3. The conservative place would be just above the R2 level. Okay, so now that we know where to put our stop losses, let's talk about targets. So the blue zones are the target zones. We have M4 as a conservative buy target and R2 as an aggressive buy target. For sellers, the conservative target is M1 and the aggressive target is S2. Now, deciding on which one you should choose is not hard at all. Actually, it's not completely up to you. Well, it's always up to you, but there are some rules. If price rallies up from the central pivot point, we go for the aggressive target. If price retraces lower and starts its move from the M2, then we go for the conservative target. And the same for sellers. a bounce from the central pivot means aggressive target, S2, and if price retraces deeper into the sell zone to M3, we aim for the conservative target, M1. So you let price make an impulse, wait for the retracement into your buy or sell zone, and then execute the trade. Always use market structure as first confirmation. It's not because price is at an M3 that we should sell. If we're in a downtrend and it's at M3, then we can sell. But if price is trending up and we're at an M3, then we should do nothing. Actually, we need to use the pivot points as some kind of stairway, stepping up or stepping down. Oh, and one more thing, you don't want to be the first who steps down or steps up. Don't be the first one at the party. Let the market show you where it wants to go and then go with the flow. Okay, that's about it for pivot points. Don't worry, it takes some practice, but we'll use them every day in our sessions. I will share my setups with you guys and give you additional information. And if you have any questions about them, let me know and we'll help you as much as we can. So again, let's delete or hide our pivots from our chart so we have a clean chart to explain the next indicator. The next indicator is a very known indicator for a lot of traders. It's the RSI, the Relative Strength Index. The RSI is another indicator that we like to use for additional confirmation. I say additional because the strategy works great without it, just by using price action, market structure combined with pivot points and moving averages. Everything else we add is just to have a higher probability rate. 100% is something that we will never get, but we can try to get it as high as possible. That's why we use the RSI as stochastics. In the course, the RSI was already explained well enough. We can see if it's showing us overbought or oversold conditions, and we can try to see if we can spot some divergence. The best places to look for overbought conditions are in a downtrend at the end of a retracement, and that's where we also like to look for bearish divergence. As you can see here on this chart, for example, and here we can see that we are having bearish divergence. Price is going up and the RSI indicator is going down, telling us that buyers are losing strength. The best places then again to look for oversold conditions are in an uptrend at the end of a retracement, and that's where we also like to look for bullish divergence. This can signal that the market is ready for another push up. So when you see a retracement and price respecting the 50 EMA, for example, in a buy or a sell zone, and the RSI is showing us that the market is overbought or oversold and diverging, I mean, it can't get much better than that. The stochastics, which we can see completely at the bottom of our screen, is one we use for an extra entry confirmation. It's a trigger. It's a momentum indicator that shows us overbought and oversold signals. Just as the RSI, by utilizing a 0 to 100 bounded range of value. We can use it to help us determine the best time to buy or sell. The levels that we use are 25 and 75, these are the standard settings. The theory goes as this: when the two lines are above the 75 level, price momentum is bullish and tends to stay bullish until the two lines cross each other and then cross down under the 75 level. The same goes the other way around. If the two lines are under the 25 level and stay under the 25 level, price momentum is bearish and tends to stay bearish until the two lines cross each other up and get back above the 25 level. So actually we're just waiting until it's at an extreme level, wait for the two lines to cross each other and then go back up or down to the middle of the zone. And again, this is just an extra confirmation. If you don't get this confirmation, it's not a problem. Oh, I almost forgot, the settings for the RSI are pretty standard, except I changed the length to 7. The style is completely up to you. If you double click in the chart, they will hide, and if you double click again, they will appear again. So mostly I just use them when I'm looking to enter, to see if I can add another layer of confirmation by looking at oversold or overbought conditions and see if I can find some divergence. The two remaining tools we like to use are the parabolic SAR and Fibonacci. Now, Fibonacci was already explained in the course. Everything should already be clear about that. Also, during the live sessions, we will use it quite frequently, so there should be no issue with that. Just one thing that I do want to talk about is Fib extension levels and how certain retracements predict certain extensions. The deeper the retracement, the smaller the impulse will be. The shallower the retracement, the bigger the impulse will be. Let me just write some rules down that you can use when you're considering to use FIB levels. A 38.2 FIB retracement predicts a minus 61.8 FIB extension level and beyond. A 50% FIB retracement then predicts a minus 38.2 up to a minus 61.8 FIB extension level. A 61.8 FIB retracement then predicts a minus 21.4 FIB extension up to a minus 38.2 FIB extension. A 78.6 FIB retracement then predicts a 100% up to a minus 21.4%. Now these are just some rule of thumbs. Of course the market isn't that black or white, but at least you have something to hold on to. Let's focus on the parabolic SAR, because that one will need a little bit more of our attention. Because it's not a regular indicator that a lot of traders use. SAR, S-A-R, stands for stop and reverse, and that's exactly what we will use it for, at least the stop part. Let's add the indicator, type in parabolic SAR. As you can see, it's selected as a favorite here. Click on it, close the window, and as you can see on the chart, the indicator appears as a series of dots placed either above or below the price candles. Dots below the candles means price is bullish. Dots above the candles indicates that price is bearish. When price is more volatile, the dots will be further apart, as you can see here, leaving more vertical space in between them. When price is printing small candles, almost in a consolidating manner, as you can see here, the dots will be very close to each other. We use the parabolic SAR in this strategy as a method to actively manually trailing our stop loss. When price is rising, we can move our stop loss to match the parabolic SAR indicator. The same concept of course applies for a short trade. As price falls, so will the indicator, and we can move our stop loss to match the level of the indicator. Every bar close will print another dot, and every time a dot prints, we can move our stop loss along. Most of the time we try to keep one dot in between. So I don't use the last dot, but the second last one. Now you don't have to use this method for moving your stop loss. You can also use market structure or price action, or just use a set of rules based on risk reward, but we will show you this in a later video on how to manage a trade. For now, these were all the indicators that we use for the impact strategy. I really want to encourage you with practicing on them. Thanks for watching, and we'll see you in the next video. Bye.